Hi, welcome to Search for Yields, the weekly newsletter from INR Bonds. I'm Arjun Patsarthi. And in Search for Yields, I'll take you through what are the best options available for investors to invest in bonds and for their fixed income portfolios, and all the issues that is surrounding the market. And apart from that, we also give a lot of knowledge on the fixed income markets, which is useful for investors and financial advisors alike. And in this edition of Search for Yields, I'm going to talk to you about a hot topic that is present globally and which is happening in India as well, which is now what is called an yield curve inversion. So, any investors and financial advisors must have read a lot of material or heard a lot of comments or seen a lot of videos on how the US Treasury yield curve is inverted, as seen in this chart. And that means it's a recession in the US and how it can affect equity investors in India and globally. Um, what is yield curve inversion? Do people know what is yield curve inversion? Very simply put, an yield curve inversion is when 1 or 2 year or 3 year or 5 year bond is trading at higher yields than a 10 year or a 15 year or 13-year bond, 30-year bond. So in the US, the 2 year US Treasury yield is trading higher than the 10-year Treasury yield, and this is giving rise to noises on recession fears in the US. And in India, we have always seen a phenomenon where the 5-year GSEC yield is trading higher than the 10-year GSEC yield. Now, this is also an inversion of sorts. And what does this mean? Um, Coming down to what it means exactly is that the short term rates are going to rise very fast or are already very high. And that is because of two factors. One is that central banks like the US Federal Reserve and the RBI are increasing interest rates. And the second factor is that the money in the system is coming down very sharply. And this is getting more and more expensive, at, especially to borrow at a short, for a short term. So put together, this is causing the yield on the short term government bonds to rise much faster than the long-term government bonds. So that is the basis of an yield curve inversion. Now, in India, what does it mean for your fixed income portfolios or for fixed income investors? And what does an investor or a financial advisor do when an yield curve is inverting? So the first aspect here is that there will be losses for investors who have already invested in products at the short end of the yield curve. So any product that is 1, 2, 3, 5 year or even 10-year maturity, if it rises very fast, that means the prices come down of the bonds they're holding, if it's an indirect product like a mutual fund, the NAV comes down. So they see losses. Now, the second is that if a fresh investor wants to invest, when yield curves when short-term yields are higher than the long-term yields, do they invest in the short-term yield or the long-term yield? Now, typically, when short-term yields are rising, that is, it's becoming more attractive. For example, if fixed deposit rates are rising, or 1 year bond or 2 year or 3 year bond that was trading at say 6% or 6.5% last year is now available at 7.5 to 8%, then it's much more attractive to invest in. But given that the yield curve is inverted, then it could also mean that at a future period point of time, the yields can come down very sharply because the central bank will also start to cut rates. And in that case, if the feeling is that the next 1 year the central bank will start cutting rates rather than raising rates, then it's better to invest in the 10-year bond or a 30-year bond, the longer maturity bonds, to get capital gains benefit, because when interest rates fall, the prices of these bonds rise much faster than the when the interest rates fall. And this is and so hence there are two factors here. One, investors, fixed income investors who have fresh money to invest can take advantage of the higher yields and invest in short maturity bonds. And when they see that long maturity yields can come down further, then they can shift to long maturity bonds. So the best way to play this yield curve inversion again is through a ladder portfolio, where an investor invests in say 2, 3, 5, and 10-year bonds, so that at all points of time the investor can take advantage at one is higher yields at the short end and the potential for longer end yields to fall. So that is what an yield curve inversion means for fixed income investors. And but however, one warning here is that investors looking for higher yielding bonds, where the issuer is not very fundamentally strong, then these can turn riskier, because when short-term rates rise and liquidity, that is money, is not available in the market, then typically money goes to the safest of the issuers, or higher or more. In some circumstances, money just dries up for many weaker issuers, and they may not be able to refinance debt, and this could lead to kind of a default, which investors can get hurt if they start to default. So investors are better off at this point of time um, taking less risk, and unless they know that even if the bond is higher yielding, the bond issuer can always get access to liquidity through either a strong promoter or through their own management of their balance sheet. Else, it is much riskier to invest in such bonds where the issuer is fundamentally weak and access to money maybe uh, may not happen, and this could rise to default risks as mentioned here. Thank you very much for listening in to Search for Yields. Do subscribe to our YouTube channel to get more Search for Yields, as well as our podcast and our daily bond market highlights, bond bites.